Imagine being 18 years old and having $10,000. Instead of buying a newer car, taking an expensive vacation, or simply spending the money, you make a different decision. You invest the entire $10,000 and then you leave it alone until you turn 60. No additional contributions, no withdrawals, just 42 years of time, compounding and reinvested dividends. So, what could that $10,000 eventually become? Let's find out. For this scenario, our 18-year-old investor divides the money between three dividend-focused ETFs. 50% goes into SCHD, 25% goes into SCHY, the remaining 25% goes into DGRO. That means $5,000 starts in SCHD, $2,500 goes into SCHY, and $2,500 goes into DGRO. All dividends are set up on DRIP, which stands for Dividend Reinvestment Plan. Instead of receiving the dividends as cash, they are automatically used to purchase additional shares. Those new shares can then produce their own dividends. Over several decades, this creates another layer of compounding. Before we look at the final numbers, let's briefly look at what our 18-year-old actually invested in. First is SCHD, the Schwab U.S. Dividend Equity ETF. SCHD focuses on established American companies with an emphasis on dividend quality and financial strength. It tracks the Dow Jones U.S. Dividend 100 Index. Rather than simply looking for the companies with the highest dividend yields, the index also considers characteristics designed to identify financially stronger dividend-paying companies. SCHD launched in 2011 and has become one of the largest and most popular dividend ETFs. Its expense ratio is currently just 0.06%. For our projection, we're going to assume SCHD produces an average total return of 7% per year. Remember, total return includes both changes in the share price and reinvested dividends. 7% is considerably below SCHD's historical annualized return, but we're purposely trying to keep this estimate conservative. Next is SCHY. SCHY is the Schwab International Dividend Equity ETF. While SCHD focuses on companies in the United States, SCHY gives the portfolio exposure to dividend-paying companies outside of the U.S. This adds international diversification. SCHY screens companies for dividend history, financial strength, dividend quality, and other factors. Its expense ratio is currently 0.08%. SCHY is also much younger than SCHD. It launched in 2021, which means we don't have several decades of fund history to work with. Because of that, we're going to be especially conservative with this part of the projection. We'll assume an average total return of 6% per year. Finally, we have DGRO. DGRO is the iShares Core Dividend Growth ETF. Unlike a fund primarily focused on producing a high dividend yield today, DGRO emphasizes companies that have a history of growing their dividends. That means the starting dividend yield may be lower, but the fund is designed to provide a combination of dividend growth and long-term capital appreciation. DGRO currently holds hundreds of U.S. companies and has an expense ratio of 0.08%. For DGRO, we'll assume an average total return of 7% per year. Again, this is significantly below its historical 10-year annualized return. Now let's see what happens to the money. Remember, our investor started at 18 with $10,000 and never invested another dollar. By age 30, 12 years have passed. The portfolio would have grown from $10,000 to approximately $21,900. That's already more than double the original investment. But this is where investing for several decades starts becoming interesting. By age 40, the investor has now allowed the money to compound for 22 years. The portfolio would be worth approximately $42,200. At age 50, the portfolio reaches approximately $81,500. Notice what happened. It took 22 years for the original $10,000 to grow to around $42,000, but only another 10 years for that $42,000 to nearly double again. That's compounding becoming more powerful as the balance gets larger. And now we arrive at age 60. 42 years have passed. Our original $5,000 invested in SCHD would have grown to approximately $85,700. The $2,500 invested in SCHY would have grown to approximately $28,900. And the $2,500 invested in DGRO would have grown to approximately $42,900. Add everything together, and the original $10,000 investment would now be worth approximately $157,500. No additional contributions, just the original $10,000, 42 years of compounding, and reinvested dividends. And there's another interesting part of this scenario. What if our investor turns 60 and decides to stop reinvesting the dividends? Using dividend yields similar to where these funds are today, This portfolio could potentially generate somewhere around $4,700 per year in dividends. That's approximately $390 per month without selling shares. Of course, that dividend income is only an illustration. Dividend yields will change over the next 42 years. Companies can increase or reduce dividends, and the funds themselves can change. But it demonstrates something important. The investor didn't just build an account balance, they potentially built an income-producing portfolio as well. Now, there are several important things to remember. This projection is not a guarantee. The stock market does not return exactly 6 or 7% every year. There will likely be years when this portfolio gains 20% or more. There may also be years when it loses 20% or more. International stocks may outperform US stocks during some periods and underperform during others. Dividends can increase, decrease, or be eliminated. And past performance does not guarantee future results. We're also ignoring taxes in this example. If these investments were held inside a taxable brokerage account, dividends could create taxes along the way even when DRIP is turned on. Taxes could reduce the amount that ultimately compounds. Inflation matters as well. $157,000 42 years from now will not have the same purchasing power that $157,000 has today. But the biggest lesson from this example isn't the exact ending balance. It's what happened because the investor started at 18. They didn't need to predict the next Nvidia. They didn't need to trade stocks every week. They didn't need to watch the market every day. And they didn't even need to contribute additional money for this particular example. They gave $10,000 something extremely valuable: time. An investor starting with more money could obviously end with more. And an investor who continued contributing every month could potentially build a dramatically larger portfolio. But even this simple example shows why getting started early can be so powerful. $10,000, 3 dividend ETFs, 42 years, and approximately $157,000 at age 60 using conservative assumptions. Sometimes the most important investing decision isn't finding the perfect investment. It's simply giving your investments enough time to grow. Thank you for watching. If you enjoyed this scenario, comment below with another portfolio you'd like to see tested, and subscribe for more beginner-friendly investing content.